Growth of the banking sector and the economy is interdependent. As the Indian economy is expected to do better in future, banks will also perform in line. With various restrictions on the cash transactions in India, the number of transactions through banking sector is only going to expand. And at this juncture, it makes sense for an investor to invest in the banking sector. The sector is expected to perform better in future, but how do you figure out today that which banks you should invest in? In today's video, we'll see what factors you should consider for the fundamental analysis of the banks. And please hit the like button so that the YouTube algorithm knows. Number 1, CASA ratio. So what is the business of banks? Banks are in the business of lending. And how do they get the funds to do the lending part? Well, they use our funds deposited in our savings account, current account, FDs, and other sources to do the lending, right? The rate of interest that banks give us on savings account is around 3.5% and no interest on the current account. So the savings account and the current account are the cheapest source of fund for the bank. Now, CASA stands for current account and saving account. And why is it important? CASA ratio shows that how much deposit a bank has in the form of current account and saving account compared to the total deposit. And the higher the CASA ratio, the better for the bank. Now, for example, CASA ratio of HDFC Bank is 46.12%. That means out of 100 rupees deposit, 46 rupees is coming from savings account and current account. Similarly, for ICICI Bank, CASA is 46.29%. For Kotak, 60%. Yes Bank, 26%. And how do banks increase their CASA ratio? Well, they offer us better interest rate for us to go deposit funds in their bank. Do you remember this Kotak ad, 6% is greater than 4%? And when banks get the number of savings account that they are targeting for, they can simply reduce the interest rate. Will the customers switch the bank quickly? Well, no, we don't. Number 2, cost of liabilities. So what are the liabilities for a bank? Well, it is our savings account because bank has to pay back that amount to us, plus interest. Similarly, the current account, the FD, any other borrowings from RBI or other financial institutions are all liabilities for a bank. The average interest that the bank pays on all these accounts is called cost of liabilities. Now, this is a cost, so the lower the better for the bank. And the lower cost increases its margin and profitability. For example, HDFC Bank's cost of liabilities is 3.81%. For ICICI, it is 3.92%. Kotak, 3.79%. Yes Bank, 5.56%. Now, you need to see this cost of liabilities in conjunction with CASA. Is CASA high just because bank is giving out higher interest, 6 to 7%? As an investor, you need higher CASA with lower cost of liabilities. Number 3, advances growth. Now, as an investor, you need your investments to grow, right? So how do you know how fast a bank is growing? You can find this out from advances growth. Advances growth in the balance sheet means how much money the bank has lent out as loans. And the higher it can lend out, the more interest it can earn and thereby increase its profit. For example, for HDFC, the advances growth rate is 20.83%. For ICICI, it's 13.71%. Axis Bank 15%. Yes Bank 8%. Now, if a higher number is better, why doesn't banks just start lending out money to everybody? Well, what if people don't pay back the loan amount? This ability to pay back the loan is measured by NPA. So number 4, NPA. A non-performing asset or an NPA is a loan for which the principal or the interest amount has remained overdue for a 90-day period. People took the loan and now they are not paying back. For HDFC, the net NPA is 0.32%. So that means out of every 100 rupees that the bank has lent out, 32 paise is not coming back to the bank. Similarly, for ICICI Bank, the number is 1.24%. For Axis, 0.73%. For Yes Bank, we have slightly higher number, 4.53%. Why is managing NPA important for the bank? Well, if your main business is giving loans and people are taking loans from you and running away with your money without paying you back, then you will not survive in the business for long, right? So for a bank, the lower the NPA, the better. Number 5, capital adequacy ratio. This is another factor that determines whether a bank can give out loans or not. This is a measurement of bank's available capital expressed as a percentage of its risk-weighted credit exposures. Simply put, CAR is critical to ensure that banks have enough cushion to absorb reasonable amount of losses before they become insolvent. In India, RBI mandates the CAR for scheduled commercial banks at 9% and for PSUs at 12% currently. Now, the better capital adequacy the bank has, the more loans they can issue, right? For HDFC Bank, CAR is 18.79%. For ICICI, 19%. For Kotak, 22%. That's good. For Yes Bank, 17%. Let's see a comparative analysis. We will click for the full peer comparison and sort this CAR highest to lowest. We'll scroll below. Let's see the lowest one available. We have J&K Bank at 12%. This lower capital adequacy can lead to lower growth in advances. Let's see J&K Bank details. Well, their advances growth rate is 3.79%. So low growth basically. And that's why it's better to have comparatively higher capital adequacy. And how do you do that? With lower NPAs. Every increase in the NPA level adds to the risk-weighted assets of the bank, which needs the bank to increase its capital base further. Number 6, net interest margin. Net interest margin is the difference between the total interest income and the expenditure. For example, most banks lend at 10% and they pay us 3.5% on a savings bank account. So this delta of 6.5% is their net interest margin. Now you see, higher CASA will improve the net interest margin of the bank because the cost of funds is relatively lower, right? 3.5%. For example, for HDFC Bank, the net interest margin is 3.64%. So that means bank earns 3.64 rupees on every 100 rupees. But it has been coming down for last 4 years. For ICICI, it is 3.4% and it has been increasing since last 4 years. For Kotak, it is even better at 4.16% and has been increasing. Number 7, PB ratio, price to book value. And what is book value? Well, this is the total value of the assets of the company which the shareholders will receive if the company were to wind down theoretically. Okay? PB ratio helps to understand that how many times the stock is trading over and above the book value of the company. PB ratio less than 1 can mean the stock is undervalued, but in a bull market, it may mean that there is something fundamentally wrong with the company. Now this PB ratio needs to be looked at in context with return on equity, ROE. A company with higher ROE will always command a higher PB ratio. Now, is this all that you need to know to do the fundamental analysis of the banks? Well, no, this is the easy part. This is just the start. Just as an investor, you need to have diversification in your portfolio. Similarly, banks also need diversification in their loans and deposit mix. This is called a granular portfolio and it basically reduces risk. How? See, if the bank issues all its loan to one sector, for example, let's say the telecom sector, and if the companies in that sector are not doing well, then the viability of the bank comes into question. That means the deposit of the general public is in question and we don't want that, right? And where will you get all this information? Well, you need to read the management commentary and the news reports. Some stockbrokers also issue their own analysis, so you can take a look at that as well. For example, if you go to the company page on moneycontrol.com and scroll below, you will see the reports of the brokers. For example, we have the broker reports from ICICI Direct, KR Choksi and other brokers as well. Now, with the ratios, we have seen how the bank has performed in the past. That was a historical information. And with the management's commentary, we will see how the bank's executive expect the bank to perform in the future. And we have not seen the valuation part yet. Valuations we'll see in the coming videos. Now we have seen a lot of quantitative ratios, but we have not compared them, hai na? Let's put them in an Excel and compare banks versus banks. So I've added the numbers in an Excel. Let me add a filter and sort the banks with highest CASA ratio top. For Kotak, we have highest CASA ratio at 60% with a reasonable cost of liabilities as well. The advances growth rate is kind of low. If you feel the numbers are off, you can actually calculate them yourself. Go to the balance sheet of the company and on the asset side, you will find loans and advances. Compare the 2 years number and let me know in the comments whether this is correct or not. HDFC has the highest advances growth rate. The NPA for Kotak is reasonable, but here again HDFC is the lowest. Capital adequacy highest, that's great. Net interest margin is highest as well, but ROE is okay. And here as well HDFC is leading. No point in discussing Yes Bank right now. And if you want to analyze more banks, you can add them in the sheet. Now I am invested in both HDFC Bank and Kotak. HDFC Bank right now is priced below the 200 DMA, which is a great point to accumulate for the long term. One thing to note is that the bank may face some short-term volatility. Why? Well, you know that HDFC is merging with HDFC Bank, and both these stocks have high institutional holdings. And so, on the merge, FIIs and DIIs may realign their portfolio, which will lead to some volatility for the bank, irrespective of the fundamentals. And you must have heard the news about the glitches in the bank's digital infrastructure. With the payment going digital and every bank and fintech competing, it will now be important for the bank to upgrade its infrastructure. The Kotak Bank as well right now is below its 200 DMA, which is a good point to accumulate. The Kotak's PB ratio is high, which means the investors are valuing it on a higher side for its higher CASA, low NPA and high net interest margin. One positive about Kotak Bank is that its subsidiaries are not listed. The bank's listed stock includes the numbers from its subsidiaries like car refinance, investment and securities, asset management, insurance, microfinance, and others. With HDFC Bank, most of its subsidiaries like AMC, insurance, etc. are listed already. So Kotak has a good chance to unlock value if it lists all its subsidiaries. So tell me which banks you have invested in. Do you prefer PSU banks? I hope you now have a basic understanding of how to do the fundamental analysis for the banks, and thank you for watching till the end. We are going to make this a series where we analyze various sectors, so let me know which sector do you want to see next. Wrapping it up, this Paritosh signing off.